Hello everyone, welcome to the 213th episode of me learning how to trade in Forex. So in the last episode we went through three simple strategies for Euro traders. So the Euro USD trend thrusts in both directions and carries the price from one level to another in a positive feedback loop. This rapid movement tends to fizzle out when the supply and demand equation shifts, which often traps latecomers in positions that will be executed for less or for losses when the currency pair reverses and heads in the opposite direction. So there's three strategies suggested from Investopedia. So the first one, pullback strategy, involves identifying significant support or resistance levels that can end the price swing and reinstate the initial trend direction. So these levels often come to prior highs or lows, as well as key levels defined by Fibonacci retracements, the moving averages, and the inception point of the original thrust. So the Euro USD pair often grinds back and forth within confined boundaries for extended periods, which sets up defined trading ranges. So patience is needed to trade entries when the support or resistance level breaks, and to reduce the timing's risk, open a partial position when the pair breaks out or down and adding it to it on the first minor retracement. So Euro USD will often rise or fall into a significant barrier and then go to sleep, which gives narrow range price bars that lowers volatility and raise apathy levels. This quiet interface often marks an entry signal for a breakout or breakdown. So the trader enters position within the narrow range pattern with a tight stop loss in place in case of a major reversal. This setup often prints a NR7 bar, which marks the narrowest range price bar of the last 7 bars. This pattern predicts the price bars will expand in a sizable breakout or breakdown, and the stop loss can be set very close to the entry price. So this last one is the NR7 one. Second one is the rise or fall into a significant barrier and then go to sleep, which gives out a narrow range price bars that lowers the volatility and raise apathy levels. And then we got currency carry trades 101. So first step to carry trade is to find out which currency offers high yield and which currency offers a low yield at a particular time. So interest rates can change at any time, so visit the website of your respective central bank to find out. Correlations between carry trades and stocks exist. Daily interest is equal to your interest rate of long currency minus the interest rate of your short currency, divided by 365 days times by the notional value. So carry trades work well in low volatility environments, as carry trades are just looking for a yield. Any capital increase is a bonus, so therefore carry traders are happy as long as the currency price doesn't fall. So carry trades work when the central banks are either increasing interest rates or planning to increase them. The key is to get in on the trade at the beginning of the rate tightening cycle and not at the end. So profitability of carry trade is questioned when the countries that offer high interest rates begin to cut them. The currency pair must either not change in value or appreciate for a carry trade to succeed. This strategy fails instantly if the exchange rate devalues by more than the average annual yield. For fast-back losses can be even more significant with the use of leverage. The liquidation can be devastating when carry trades go wrong. So now we're on to central bank risk. So carry trades will also fail if a central bank intervenes in the foreign exchange market to stop its currency from rising or to prevent it from falling further. So carry trades fail when or if a central bank intervenes in the foreign exchange market to stop its currency from rising or to prevent it from falling further. An excessively strong currency could take a big bite out of exports for countries that are dependent on exports. An excessive strong currency could take a big bite out of exports for countries that are dependent on exports. An excessively weak currency could hurt the earnings of companies with foreign operations. The central banks of these countries could resort to verbal or physical intervention to stem the currency's rise if the Aussie or Kiwi should get excessively strong. Any hint of intervention could reverse the gains in the carriage rates. So an excessive strong policy could take a big bite out of exports for countries that are dependent on exports. So, if you got a country and then your country is dependent on the exports, on your exports, if your currency is really strong, that means the foreign currency would have to pay more in order to get 1 unit of your currency. So that means for the same amount of money, if you got a really strong currency, say for example £1 equals 10 USD or something like that, so it takes 10 USD to exchange for £1 and you have £100 of stock exports are ready to be exported. If the US sets a budget of say just 100 to buy $100 worth of exports from the UK, then that means they could only get around 10 whatever of the exports, because each pound is $10, so, and they have a budget of 100, so that means they could only get 10 pounds worth of exports. But say your currency isn't excessively strong, it only takes about, I don't know, $5 to get £1, then with the same budget 100, the US could buy 20 pounds worth of exports. So they could gain more exports. And it also means they would be able to sell more because stuff is cheaper, so they can sell more. Well, not cheaper, but if the currency isn't that strong, they could sell more, which is good for the economy. An excessively weak currency could hurt the earnings of companies with foreign operations. An excessively weak currency could hurt earnings of companies with foreign operations. So if there's a company in another country, could hurt the earnings of companies with foreign operations, and they're earning money in another country, so for example USD, then when they have to convert USD back into GBP, if the currency is too weak, that means they would have to excessively weak currency could hurt the earnings of a company's foreign operations. So what? So companies with foreign operations means they've got earnings outside in a foreign country. So if they got earnings in a foreign country, and then they've tried to convert it back to the home currency, then surely that means if they've got a weak currency, they could get more of the home currency if it's weaker. But how would that hurt the earnings though? Could hurt the earnings of companies with foreign operations. How would that hit foreign operations? Country with foreign operations. Companies with foreign operations. So foreign operation. Horrible handwriting. So that means they would have branches in other countries. In other countries and foreign operations. If they've got foreign operation branches in other countries, that means I thought they would have to convert the earnings from the other countries into your home country, into the currency of your home country. But then if your home country's currency is weak, wouldn't that mean it's better, because then you can get more of your home currency if you convert it from the foreign currency? Because if the currency is weaker, you can get more of it. The central banks of these countries could resort to verbal or physical intervention to stem the currency's rise if the Aussie or Kiwi should get excessively strong. Any hint of intervention could reverse the gains on the carry trades. Excessively strong currency could damage the export count for the countries which are export dependent. An excessively weak currency could hurt the earnings of companies with foreign operations. Could hurt the earnings of companies with foreign operations. If only it were this easy. An effective carry trade strategy doesn't simply involve going long on a currency with the highest yield and shorting a currency with the lowest yield. The current level of the interest rate is important, but the future direction of interest rates is even more important. The USD could appreciate against the AUD if the US Central Bank raises interest rates at a time when the Australian Central Bank is done tightening. Warning: carry trades only work when the markets are complacent or optimistic. Carry trades only work when the market is complacent or optimistic. Uncertainty, concern, and fear can cause investors to unwind their carry trades. Uncertainty, concern, and fear can cause investors to unwind their carry trades. The best way to carry trade. One central bank may be holding interest rates steady while another may be increasing or decreasing them. Any one currency pair only represents a portion of the whole portfolio, with a basket that consists of the 3 highest and the 3 lowest yielding currencies. The losses are controlled by owning a basket even if there's carry trade liquidation in one currency pair. The losses are controlled by owning a basket even if there's a carry trade liquidation in one currency pair. So don't put all your carry trades on one currency pair, put it all in a spread it out. This is the preferred way of trading carry for investment banks and hedge funds. The strategy may be a bit tricky for individuals because trading a basket would require greater capital, but it can still be accomplished with smaller lot sizes. The key with a basket is to dynamically change the portfolio allocations based on the interest rate curve and the monetary policies of the central banks. One central bank may be holding interest rates steady while another may be increasing or decreasing them. Any one currency pair only represents a portion of the whole portfolio of a basket that consists of 3 highest and 3 lowest yielding currencies. Have a trade portfolio. Have a carry trade portfolio of the 3 highest interest currencies and 3 lowest interest currencies. Key of a basket is to dynamically change the portfolio allocations based on the interest rate curve and the monetary policies of central banks. So the key with this is to dynamically change the portfolio allocations. Change the portfolio allocations based on the interest rate curves and the monetary policies of central banks. Benefiting from the carry trade. The carry trade is a long-term strategy that's far more suitable for investors than traders. Carry trade is a long-term strategy that's more suitable for investors than traders. Investors will be happy if they only have to check the price quotes a few times a week rather than a few times a day. Carry traders, including leading banks on Wall Street, will hold their positions for months, if not years at a time. The cornerstone of the carry trade strategy is to get paid while you wait. Trends in the currency market are strong and directional partly due to the demand for carry trades. Trends in the currency market are strong and directional trends in the currency markets are strong and directional, partly due to the demand for carry trades. This is important for short-term traders because it may be far more profitable to look for opportunities to buy on dips in the direction of the carry trades than to try to fade it in a currency pair where the interest rate differential is very significant. Trends in the currency market are strong and directional, partly due to the demand for carry trades. This is important for short-term traders because it may be far more profitable to look for opportunities to buy on dips in the direction of the carry than to try to fade it in a currency pair where the interest rate differential is very significant. Far more profitable to look for opportunities to buy on dips in the directional of the carry than to try to fade in a currency pair where the interest rate differential is very significant. Buy on dips in the direction of the carry. So buy on the directional change than to try to fade it in a currency pair where the interest rate differential is very significant. I don't even know what fading means. Those who insist on fading AUD-USD strength should be aware of holding short positions for too long because more interest will have to be paid with each passing day. Best way for short-term traders to look at interest is to keep in mind that earning it helps to reduce your average price while paying interest increases it. The carry won't matter for an intraday trade, but for the direction of carriage becomes more meaningful. The carry won't matter for an intraday trade, but the direction of carry becomes far more meaningful for a 3, 4 or 5 day trade. So intraday means within 1 day, but the direction of carry becomes far more meaningful for 3, 4 or 5 day trades. Okay. How do you profit from carry trades? Investors earn interest on the currency pair held in a foreign exchange carry trades. The currency pair may move in either direction. You earn the capital appreciation in addition to interest if the pair moves in your favor. You recognize a capital loss if the pair moves adversely. What are the best carry trade currencies? Currency values, exchange rates, and prevailing interest rates are always fluctuating, so no single currency is always the best. The most popular carry trades generally involve buying pairs with the highest interest rate spreads. So currency with a high interest rate and a currency with a low interest rate. That's the interest rate spread. Is carry trading profitable? The theory behind carry trading is to borrow one asset to buy another. You remain in a profitable position as long as the interest rate you're charged to borrow one asset is less than the interest you receive for the asset you buy. Either currency may fluctuate in value and change your position. However, trading fees or administrative costs can impact your profitability even more. The theory behind carry trade is to borrow one asset to buy another. You will remain in a profitable position as long as the interest you're charged to borrow one asset is less than the interest you receive for the asset you buy. Either currency may fluctuate in value and change your position. However, trading fees or administrative costs can impact your profitability even more. How do you hedge a carry trade? Natural carry trades are unhedged, so investors can hedge their position by purchasing options. You can buy a call option to limit the trade loss potential should the foreign currency depreciate in value for a long position on a foreign currency. Natural carry trades are unhedged, so investors can hedge their position by purchasing options. You can buy a call option to limit the trade loss potential should the foreign currency depreciate in value if you're a long position on a foreign currency. Bottom line, a trader attempts to take advantage of differences in interest rates in a carry trade. Rate differences may be small, but carry trades are often executed with leverage to enhance profitability potential. Carry trades are often popular in the foreign exchange market. You can begin carry trading by understanding which currencies offer high yields, which offer low yields, and how you can optimize these positions. Differences may be small, but carry trades are often executed with leverage to enhance profitability potential. Okay. Next one, interest rate parity. Interest rate parity is the fundamental equation that governs the relationship between interest rates and currency exchange rates. Interest rate parity is a fundamental equation which governs the relationship between interest rates and currency exchange rates. Basic premise of interest rate parity is that hedged returns from investing in different currencies should be the same regardless of the level of their interest rates. The basic premise of interest rate parity is that hedged returns from investing in different currencies should be the same regardless of the level of interest rates. Hedged returns from investing in different currencies should be the same regardless of the level of their interest rates. There are two versions of interest rate parity: covered interest rate parity and uncovered interest rate parity. So, two versions of interest rate parity: covered and uncovered. Read on to learn what determines interest rate parity and how to use it to trade the Forex market. Key takeaways: interest rate parity is the fundamental equation that governs the relationship between interest rates and currency exchange rates. The basic premise of interest rate parity is that hedged returns from investing in different currencies should be the same, regardless of the level of their interest rates. Parity is used by Forex traders to find arbitrage or other trading opportunities. So calculating forward rates. Forward exchange rates for currencies are exchange rates that anticipate the rate at a future point in time. Forward exchange rates are exchange rates which anticipate the exchange rates at a future point in time, as opposed to spot exchange rates, which are current rates. An understanding of forward rates is fundamental to interest rate parity. As opposed to spot exchange rates, which are current rates, an understanding of forward rates is fundamental to interest rate parity, especially as it pertains to arbitrage, the simultaneous purchase and sale of an asset in order to profit from a difference in the price. And an understanding of forward rates is fundamental to interest rate parity, especially as it pertains to arbitrage. As it pertains to arbitrage, the simultaneous purchase and sale of an asset in order to profit from a difference in price. So, arbitrage, the simultaneous purchase and sale of an asset in order to profit from a difference in price. Basic equation for calculating forward rates of the USD as a base currency is forward rate is equal to spot rate times by 1 plus interest rate of overseas country over 1 plus interest rate of domestic country. So forward rate is equal to spot rate times by 1 plus interest rate of overseas country divided by 1 plus interest rate of domestic. 1 plus interest rate of domestic country. Okay. Forward rates are available from banks and currency dealers for periods ranging from less than a week to as far as 5 years and beyond. Forward rates are available from banks and currency dealers for periods ranging from less than a week to as far as 5 years and beyond. As with spot currency quotations, forwards are quoted with a bid-ask spread. A currency with low interest rates will trade at a forward premium in relation to a currency with high interest rates. So a currency with lower interest rate will trade at a forward premium in relation to a currency with a higher interest rate. A currency with lower interest rates will trade at a forward premium in relation to a currency with high interest rate. In the example shown above, the US dollar trades at a forward premium against the CAD. For example, conversely, the CAD trades at a forward discount versus the USD. What's the example? What? USD, is it this one? The USD is a base currency. Low interest rate, trade at forward premium in relation to a high interest rate. Trade at a forward premium. So, trades at a forward premium against the CAD. US lower will trade at forward premium in relation to the CAD. So, does the USD have a lower interest rate than the CAD? Can forward rates be used to predict future spot rates or interest rates? On both counts, the answer is no. A number of studies have confirmed that forward rates are notoriously poor predictors of future spot rates. Given that forward rates are merely exchange rates adjusted for interest rate differentials, they also have little predictive power in terms of forecasting future interest rates. Poor predictors of future forward rates. Future spot rates. Given that forward rates are merely exchange rates adjusted for interest rate differentials, they also have very little predictive power in terms of forecasting future interest rates. Forward rates are merely exchange rates adjusted for interest rate differentials. They also have very little predictive power in terms of forecasting future interest rates. So, forward rates have very little power, very little predictive power, of forecasting future interest rates. Forward rates have very little predictive power of forecasting future interest rates. As forward rates are merely Exchange rates adjusted for interest rate differentials. Adjusted for interest rate differentials. Example. Oh, here's the example. Consider the USD and CAD rates as an illustration. Suppose our spot rate for the CAD is presently 1 USD equals 1.0650 CAD. Ignoring bid-ask spread for a moment, using the above formula, the 1-year forward rate is computed as follows. So, the top one is overseas and bottom was domestic. So overseas is a UCAD, bottom one is a USD interest rates. Difference between the forward rate and spot rate is known as the swap points. Difference between forward rate and spot rate is known as swap points. In the above example, the swap points amount to 50. Was it 50? Oh, because 700 minus 650 is that 50? If this difference forward rate minus the spot rate is positive, yeah, so that minus that, it is known as forward premium. A negative difference is deemed a forward discount. If this difference is positive, it's known as a forward premium. If this difference is negative, it's known as a forward discount. Covered interest rate parity. With covered interest rate parity, the forward exchange rates should incorporate a difference in interest rates between two countries. With covered interest rate parity, the forward exchange rates should incorporate difference in interest rates between two countries. Otherwise, an arbitrage opportunity would exist. In other words, there is no interest rate advantage if an investor borrows in a low interest rate currency to invest in a currency offering a higher interest rate. Typically, the investor would take the following steps: borrow an amount in a currency of low interest rate, convert the borrowed amount in the currency of a higher into a currency of high interest rate. Investor proceeds in an interest-bearing instrument in this high interest rate currency. Simultaneously hedge exchange risk by buying a forward contract to convert the investment proceeds into the first low interest rate currency. Forward exchange rates should incorporate difference in interest rates between two countries. Arbitrage opportunity would exist. In other words, there is no interest rate advantage if an investor borrows in a low interest rate currency to invest in a currency offering a high interest rate. The returns in this case will be the same as those obtained from investing in interest-bearing instruments in the lower interest rate currency. Under the covered interest rate parity condition, the cost of hedging exchange risk negates the higher returns that would occur from investing in a currency that offers a high interest rate. What? With covered interest rate parity, forward exchange rates should incorporate the difference in interest rates between two countries. Forward exchange rates. Incorporate a difference in interest rate between two countries. Otherwise, an arbitrage opportunity would exist. In other words, there's no interest rate advantage if an investor borrows in a low interest rate currency to invest in a currency offering a high interest rate. But isn't that the point of a... No, this is interest rate parity, not a carry trade. So, investor will take the following steps: borrow an amount that is in a currency with a low interest rate, convert the borrowed amount to currency with a high interest rate. The investor proceeds into an interest-bearing instrument in this high interest rate currency. Simultaneously hedge exchange risk by buying a forward contract to convert the investment proceeds into the first, which is the lower interest rate currency. The returns in this case will be the same as those obtained from investing in interest rate bearing instruments in the lower interest rate currency. So the returns will be the same as if you had not converted your currency into the currency with the higher interest rate. So the output will be the same as if you had invested in just your own lower interest rate currency interest bearing instrument. Under the covered interest rate parity condition, the cost of hedging exchange risk negates the higher returns that would occur from investing in a currency that offers a high interest rate. The cost of hedging exchange risk. So this is saying that the cost of hedging this would cancel out the higher returns that you would get from investing in a currency that offers a higher interest rate. You know what? I'm going to leave this episode here actually. See you later.